look at the economic fallout of all of this with Ann Berry, the Wheelhouse Chief Investment Officer, Dan Geltrude, Geltrude and Company founder. And Ann and Dan, if you don't mind, I do want to look at that because I think Ted Karkus mentioned something very interesting that we're hearing now separately in a New York Times report on the administration's new strategy dealing with COVID, to recognize that it's going to be around. It will be a part of us. It will be endemic in our society, and maybe much like the flu, as Ted was saying, it's just part of who we are as a country now. Have we gotten our arms around that? What do you think, Ann?
I don't think we have quite yet, Neil, and I think that's because we're still seeing the variants that are coming out show new characteristics. In this case with Omicron, it was the speed and its level of contagion of it. So I think we will get our arms around it, but I think we need to see these different iterations and these new variants look a little bit more similar to each other before there's the level of comfort that I think we have as a community with something like the flu. I'm hopeful at least that we get there. I'm just not sure we're going to be there quite yet.
You know, if you think about it, Dan, all these businesses that are now telling their businesses or their workers to continue working remotely if they so wish for at least another couple of weeks. As you know, the new New York Mayor, Eric Adams, had said, not so fast on that. That's not good for the workers, certainly not good for our city. But it's falling on deaf ears. These guys who had very, very tight reins on keeping their people in New York are now changing their minds and saying, well, for now, you don't have to come into New York. What do you make of this and how that's going to impact the economy?
The problem here, Neil, is the mixed messaging that people are getting. So for a while, it was, we need to get back to work. Now it's not so fast. It's more contagious, but it's not too bad. So you can't blame people for being totally confused. Now that confusion is going to trickle down to what's going on with the economy, because right now I would say people have that attitude of, we're heading into another bad streak here. Keep people at home. Let's slow things down. Therefore, companies, businesses can't get people to work. And that really, Neil, is the entire problem that we have in the economy right now. It is all driven by labor shortage, which is driven by the virus and how we're reacting to that virus from a policy standpoint.
You know, if the virus is stabilizing, I don't want to get ahead of myself, Ann, and even with these spikes in cases, they're not as serious cases. You've heard that again and again. Then we're back to worrying about things like inflation, I guess, or we're worrying about the impact of maybe more rate hikes than we figured and bigger rate hikes than we figured. Where are you on this?
Look, I think the Fed minutes that came out yesterday, Neil, were incredibly instructive. There had always been this instinct in the market that the Fed would start to raise rates. I think that the surprise was a little bit how hawkish they are and how quickly those rates may come. Frankly, it's been coming for a long time. It is overdue to get this level of clarity. And I think what we're seeing at the moment is certainly the financial markets rebalancing their portfolios to be ready for this moment. They knew it was about when, not if, and now we're getting that clarity. And I think more broadly, businesses can start focusing on things like unlocking their supply chains in a more normalized environment, demand planning in a more normalized environment. And then to touch on the labor market again, Neil, a huge thing here has been how to get kids back to school so parents can go back to work. So I think education is another sector that hopefully will look at normalizing in a slightly more stable economic environment as well.
But, you know, one where the rates are backing up, Dan, 10-year note now around 1 3/4%. A year ago at this time was under 1%. Still very low, but going higher. What do you think?
Well, that trend, Neil, may very well continue, especially if what the Fed is signaling in terms of increases in the interest rate. Well, that's certainly going to have an impact on the market. We see that the market kind of reacted in that they didn't expect the Fed to be quite as hawkish. So I think they'll settle in a little bit now. But if that trend continues, Neil, we're going to see those bond yields continue to rise, and we're going to see more adjustments going on in the stock market and those equities.
All right. Well, we'll see how those adjustments go, as long as they're not too jarring. But recent history suggests they can be. Guys, I want to thank you both.